2008 Financial Crisis Explained: Causes, Timeline, and Amounts. The 2008 financial crisis costed $1.5 trillion. Here you can find key financial concepts to understand the crisis explaining the financial argot. It is difficult to synthesize the 2008 financial crisis in a few minutes without missing important information. But if I have to do it, I would focus on the main bad idea that triggered the crisis. That idea was to take loans given to people that are not good payers and sell them recombined to other groups, assuming there will be never a consequence if this schema escalates. That crisis led to the Great Recession, where houses prices plunged more than during the Great Depression of 1929. This video includes 51 reliable sources. Reputable sources include government sites like the Congressional Budget Office, through specialized institutions that protect people's money like the Federal Deposit Insurance Corporation, regulators like the Securities and Exchange Commission, and even documentaries like one from HBO. Now let's see the gist. Every decade or so, something happens along that, at least in the short term, devastates financial markets. That, based on recessions marked by the National Bureau of Economic Research. A financial crisis has consequences such as millions of people losing their homes, jobs, and savings. The crisis was getting bigger and the government intervened before many serious effects appeared. One serious impact is seen when banks stop giving credit. Many companies rely on credit given by banks for short-term payroll. So, without credit, many people would not get their salaries. If there is no faith in the financial system and people get their money out of the bank cannot have the money needed to lend to small businesses. Pension funds and retirements, like 401ks, were at risk due to bad investments they held. So now let's review the key numbers. What are really the key numbers of the 2008 financial crisis? How did we reach the total of $1.5 trillion? Let's start with a kind of timeline. First of all, in March 2008, the Bear Stearns bailout for 30 billions. Then in July 2008, the Fannie and Freddie bailout costed 187 billions. Afterwards, in October 2008, the Troubled Assets Relief Program, most known by its acronym TARP, costed 475 billions. Initially, it was 700 billions, but with the Dodd-Frank Act, it was reduced to 475 billions we see here. Later, in November 2008, the AIG bailout costed 182 billions, but as a profit was done, finally, the final result generated 22.7 billions in profit. Then we have between 2009 and 2019 the American Recovery Reinvestment Act for $831 billion. It is worth noting that unemployment remained higher than 9% from mid-2009 to the end of 2011. Housing prices fell 26% between 2007 and 2012, and 172 billion were moved from money markets to treasury bonds. Now let's consider the crisis evolution through a few key concepts. Let's start with leverage, for example. What is leverage? Leverage is borrowing money to amplify the outcome of a deal. For example, one person has $10,000. That person buys one box and sells it for $11,000. Makes $1,000 profit. It means 11,000 minus 10,000, 1,000 profit. Another person using leverage borrows 1 million with that $10,000. That person has now $1 million to buy 100,000 boxes, sells 10,000 boxes for $1.1 million and pays the 1 million borrowed. Then this person is able to make 90,000 profit. That is the difference between 1.1 million that he sold minus 1 million that the boxes costed minus the $10,000 he initially had. As the person with leverage gets more returns, banks apply the same principle trying to get higher returns. Why is this important, you might ask? Well, it is important because people trying to become homeowners are using leverage. They borrow money to get the money to buy the house. And thanks to that money they got, they obtained a house, but they obtained also a mortgage. A mortgage is a loan a person requests to a mortgage lender to be able to get the money needed to buy the house. So there, the mortgage broker appears. The mortgage broker is contacted by want-to-be homeowners to get a mortgage and buy their house. Mortgage brokers ask a mortgage lender for a mortgage. Mortgage broker makes a commission and people become homeowners. So there we noted that he asked a mortgage lender to provide a mortgage. So the initial mortgage of the homeowner is at this point transferred to the mortgage lender, and the mortgage lender provided the mortgage broker the money to give it to the homeowner. So the mortgage lender, once again, is contacted by a bank that wants to buy the mortgage. Mortgage lenders get money for lending mortgages from Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac give thousands of mortgages to investment banks. Why? Because banks wanted to create MBS, called also mortgage-backed securities. This is what investment banks were creating. Mortgage-backed securities are the securitization of mortgages. It means it converts an illiquid asset into a liquid one that can be sold and bought. Those MBS were held by financial institutions around the world, hedge funds, mutual funds, corporate assets, and pension funds. Homeowners' payments were going directly to the MBS owners, and MBS owners were hedge funds, investment banks, pension funds, insurance companies, sovereign funds, mutual funds, but those were not the only ones. As there were more and more companies willing to buy those MBS, investment banks created something called CDO, collateralized debt obligations. Banks borrowed more money to buy more mortgages and packaged them into buckets, called CDOs. Their prices relied on sophisticated computing pricing models based on the assumption that house prices always go up. The tranches were sold to investors with high risk on higher return MBS. As investors searched higher returns, they bought those higher return, higher risk MBS. CDO's returns came from homeowners paying their mortgages. That freed banks from collecting the mortgage of the loans they made, so they kept building mortgages and lending to people with low paying capabilities. Tranches were classified by risk. For example, safe, okay, and risky. First, money collected from mortgage payments went to safe, then to okay, and what was left to risky. As less homeowners pay, the risky tranche is the first impacted. To compensate for the higher risk, there is a higher rate of return in riskier tranches. For instance, 10% for risky, 7% for okay, and 4% for safe. Traders started selling CDOs. Some of them were giving high rating. As we can see in this infographic, the rating AAA is among the highest, quite reliable. In fact, lax lending requirements and low interest rates made home prices go higher, and that made MBS and CDOs look like good investments. And as we can see also in the infographic, insurance companies created credit default swap (CDS) to ensure MBS. To add even more security, banks sought insurance for the CDO's safe tranche using a credit default swap. Reliable insurance companies like the American International Group, also called AIG, sold insurance products in risky tranches. It was called credit default swap. However, the company did not expect that all mortgages would be insolvent, and it did not have the cash on hand to pay to everyone. Those CDS were derivatives not regulated. The Federal Reserve bailed out AIG to keep it from going bankrupt. Without it, all companies and pension funds owning CDS would have gone bankrupt. There were even other products like CDIs for complex derivative investments. Those were more risked than MBS and CDOs. Complex derivatives investments included synthetic CDOs. Those were created to put even more money in their creditors' pocket. And also we have to consider the rating agencies that qualify securities by their risk level. For instance, safe CDOs as AAA because before mortgages were only for good borrowers, so mortgage debt was a good investment. More than half of structured finance securities rated by Moody's carried a AAA rating. The OK tranche could be seen as a BBB, and the risky tranche as unrated. Considering these ratings, banks can then sell the CDOs to investors groups according to their risk appetite. As CDOs are sold and homeowners paid, investors received the return they expected, so they asked banks to get more of them. And what happened at that point? The cycle is going backwards from 5 to 1. Banks asked mortgage lender for more mortgages. Mortgage lender asked the mortgage broker for more potential homeowners, and the mortgage broker could not get more people to qualify for a mortgage. What happened then? There was an idea to solve that, and it was subprime mortgages. What happened at that moment? Investors wanted to buy more MBS because they were profitable. Then banks started to make subprime mortgages, loans granted to individuals with poor credit histories. This to provide more investors the high returns alternatives investors were looking for. Angelo Mozilo from Countrywide Financial was the indisputable king of subprime lending. His company was then sold to Bank of America. He encouraged the sales but admitted they were toxic. They were sold anyway to Wall Street firms. If a homeowner does not pay, the lender gets the house and typically houses go up in value. So lenders started to add more risk. With no down payment, no proof of income, less restrictions to get a credit for a house. At that moment there was a shift from responsible homeowners, called prime mortgages, to less responsible homeowners, called subprime mortgages. That led also to predatory lending practices. What is that? Financial institutions did not really verify the repaying capacity of individuals. Those mortgages included payments people could afford at first, but not later as mortgages monthly payments ballooned above their means. Maxine Waters, an US Congresswoman, confirmed teaser loans were announced at the beginning and then later higher payments were due. The most complicated mortgages were given to people who did not understand them and were not able to pay for them. So now we are reaching the turning point with subprime mortgages and predatory lending practices. But mortgage brokers still make a commission when selling a mortgage to a mortgage lender. Mortgage lenders still make a commission when selling the mortgage to an investment bank. and investment banks turns them into CDOs and sell them to investors. This situation leads to a moral hazard. This is when one person takes more risk because someone else bears the burden of the risk. Fees were added in every transaction with every participating enterprise. The broker, lender, securitizer, market maker, every participating enterprise was sure the risk was transmitted to the next and had already received a commission. Banks made the loans because they were expecting to sell the mortgages to somebody else. And then there was a housing bubble, or at least most people thought it was. It is when houses prices raised to unsustainable levels, mainly due to speculation and not real value. At a certain point, people started to default on their payments. What does it mean? Borrowers started not being able to pay the mortgage's monthly payments. That is default of a payment. That put homes again in the market. But there were no buyers and prices started to go down. In other words, offer of homes was high and demand that can pay for those houses was low. Once subprime lenders started defaulting, the money from homeowners started not going to CDOs anymore, as now investment banks owned a house and not anymore the money from monthly payments. As more and more homeowners defaulted in payments, the payments turned into houses. So many investors started to realize they had toxic assets. In August 2007 in Paris, BNP Paribas discovered the toxic securities, MBS, CDOs, and stopped withdrawals from related funds. They raised the alarms. All that led to the housing bubble burst. Many houses were in the market and nobody bought them. Then home prices started to go down. That created problems to homeowners still paying their mortgages because their house value started to decrease. They did not want to pay mortgages on houses that were not anymore the value they agreed when they took the mortgage. Their houses were not anymore going up in value. As home prices fell, borrowers saw their house value decrease and stop paying, hence pushing houses prices low further. As more and more payments on houses were not done, CDOs had not any more money flowing from home owners to investors. Instead, banks had many houses whose values were going down. Banks tried to sell those CDOs to others, but no one wanted them as most new homeowners were not paying. Nevertheless, banks had already borrowed billions to create CDOs but were not able to sell them. Investors had already bought many of those CDOs, not returning any profit and were trying to sell them. Nobody was buying them. Mortgage lenders already had many subprime mortgages they were willing to sell to banks. No bank was buying them. Mortgage broker is offering subprime lenders to mortgage lenders, but no mortgage lender wants to give money to subprime mortgages. Later, there was no credit and banks and mortgage brokers started to go bankrupt. When bubble burst, big financial institutions stopped buying subprime mortgages. Subprime lenders were stuck with bad loans. That led to frozen credit markets. When housing prices started to fall in 2006, the pricing computing models were not anymore usable. No pricing nor value could be established on MBS, and banks stopped lending each other, which in turn froze credit market and the economy. Even Warren Buffett said he would have needed to read 300,000 pages to understand a mortgage-backed securities, or MBS. In 2007, banks started to panic once they realized they would have to absorb the losses and stopped lending each other. They did not want worthless mortgages as collateral, so interbank borrowing costs like LIBOR rose. Even when the Fed pumped liquidity via the term auction facility, it was not enough. In London in September 2007, Northern Rock asked Bank of England for emergency financial support. People were running on banks to get their money. In October 2007, UBS was the first major bank to announce losses of 3.4 billion from subprime-related investments. This kind of videos requires time to do the proper research. You are obtaining the results here and avoiding many hours of online research as I have done it for you. If you appreciate its value, please like it and click on the subscribe button to stay tuned for more. Have a nice day and see you soon in another video.